afternoon, well, the topic of the session is funds of funds. Funds of funds have been developing over the last years, when especially the focus of this session is on funds in venture capital and buyouts. Well, I'm very pleased to introduce the speakers. So the speakers are first two funds of funds specialists with a different emphasis. First, Filippo Gioli from Access Partners will talk about well, his company and the performance of the funds that the funds of fund that he's managing. Filippo Gioli, he's a graduate from Marseille Business School. Then he worked on private equity. He worked for some years with the European Commission, especially on R&D funding and seed companies, finding funds for seed companies. And well, he's now a partner at Access Partners, which is a fund of fund firm. And then we'll have Laura Shen, who graduated from Harvard. She earned an MBA at Harvard Business School. She also earned degrees in economics and political science from Amherst College. After graduating, she started with the Goldman Sachs and Bain and Company, and later worked for a few years with Cotter, which is one of the most important firms in secondary funds. So that's another emphasis. And she started a new company this year. She's a co-founder of a new company. So she will present the company, which is called Headway, and what they do. And finally, we will have a presentation on the family office by Bernard Chamblin. So Bernard Chamblin is actually the head of the Family Office Association in France, and also he's in charge of family office as mascot. So I think, well, probably you can start. And
Okay, thank you very much. And I think it's a good opportunity to have a diverse panel with both people on the sell side, because Laura and myself, working with fund of fund companies, are obviously pushing forward our services, but also having the critical eye from people who are on the buy side. And I think it's interesting to have Mr. Chamblin from the family offices point of view in order to have some more challenging questions later on. So what I will try to do is to be relatively brief on the presentation of the subject from the point of view of Access, as we may evolve into more of a lively debate, I hope, later on. If you allow me a few words on Access. One more. We are a pretty focused fund of fund, as we are exclusively dedicated to the European market, and we focus mostly on mid-market buyouts throughout Europe, as well as venture capital. We offer both standard fund of funds products for any kind of investors, as well as discretionary and non-discretionary advisory services to specific investors, so more of a tailor-made type approach. The company was founded in 1999. It's independent. It's 16 people with 3 partners who own the majority of this business. So I would really emphasize the independence in our characteristics. Today we have 810 million euros under management from a very broad base of investors. About 90% of the capital that we've raised so far comes from outside of France. And 90% of the capital we then deploy outside of France in the European market. Our investor base is mostly institutional, with very large pension funds, insurance companies, as well as some more modest investors, be it small institutions or private individuals and family offices. Our focus is Europe only because we believe that we understand that market pretty well, that it is important to be exhaustive in your approach to such a market. There's probably something like 700 or 800 private equity managers if you put buyout and venture together all throughout Europe, and it is important that you derive that a selection from that very wide universe in the most professional way as possible. Yes. Our characteristics is to be mostly focused on mid-market buyouts. The reason for that is that we don't believe there is a lot of value in bringing investors to the best top 20 mega funds in Europe because everybody knows who they are. It's more a question of can you have the minimum ticket to get into those funds, but it's definitely not an issue of identifying who they are. We tend to focus on the next level down, which is funds with sizes in between 100 and 1 billion euros, who tend to be focusing on smaller companies. And we do see a value in the fund-of-fund model in aggregating a pan-European portfolio of such mid-market buyout teams. Doing that, we back emerging managers as well as very established managers. I mean, I would say that our portfolio is funds that are ranging from generation 2 to generation 7. So on average, pretty experienced people. In the VC world, which is an extremely difficult market today in Europe, because I mean that market has been going through a tough crisis on technology investment. We're now looking at the remains of a sector, and I think finding your way through those survivors of the tech bubble is something that takes a lot of research and relationship, and this is also a service that we offer to investors. Merci. Coming to the discussions that we will elaborate on further in the debate, the reason why a fund-of-fund exists as a service is to try to find the way through the very strong variation in performance that private equity funds are producing overall. This is a general view of European private equity over the years in terms of the performance of the whole sample from top to bottom quartile. And you will see that, I mean, shooting random in that very wide disparity of manager performance can take you to the middle or the bottom. It will be extremely difficult to hit the top quarter because in that top quarter, first of all, there are capacity constraints in terms of capital that can be deployed. People tend to change. I mean, the best performance of yesterday are not necessarily the best performers of tomorrow. And at the same time, it is a large group. So deriving a selection must be research-based. And that's where we believe our service is of value. Next. I was also asked by the organizers to dig some figures as to the risk-reward ratio of funds versus funds of funds. And the data that is shown here comes from a study that was commissioned by the European Investment Fund in Luxembourg and done by academics. Looking at portfolios over in the States and over in Europe, understanding what was the probability of a loss going in a venture fund or going in a buyout fund single-handedly versus putting together a fund-of-fund portfolio on a pure statistical basis. It clearly shows, and one would expect that the risk-reward ratio, and particularly the risk of total loss of funds is much smaller than for other categories of investments such as fund investment. And that clearly diversification is one of the major services that one can render investors. For my last words, I would try to provide an example of how you get to a selection of funds. And I would take for that the market that we know best, which is mid-market buyouts in Europe. There's about 190 buyout general partners in the European market. About 20 of them are the so-called mega funds. That means the last fund they raised was about $1 billion, and the bigger would be a Permira with $5 billion for the last fund. Those 20 are not our turf. So what we concentrate on is the 170 that would be mid-market. looking at transaction sizes in between 50 and 250 million euros, with fund sizes between 100 million and 1 billion. Out of those 170, having screened them all over the last 6 years and spending our time researching that market, we find that at any point in time, there's no more than 50 of them that would be investment grade, in the sense that in terms of past performance, methods, professionalism, depth of their market, they would really meet our criteria, and that's a pretty large number. If you look at where these people are based, you will see that although there's a dominant proportion of them in the UK, they tend to be scattered across Europe in a pretty nice way. You would see that most of these people are pretty seasoned as they are raising or managing their second, third, fourth, or fifth generation funds. And our bias would be necessarily that they would be focused on smaller companies. So, I mean, this would be an investment universe from which to derive selectivity. But to get to the level of information that you need in order to make a selection, you need a large team, and you need to perform continuous research, have continuous meetings with these people, due diligence them with their CEOs of portfolio companies, due diligence them with the lenders of the senior debts, due diligence them with their investors, their competitors. It takes quite a lot of time. And then you have to derive your selection based on criteria. And then depending on what is your focus, you will emphasize certain criteria. Clearly, the experience is going to be one. We're not experimenting with money. We're trying to go where performance is. Then we would, for instance, be concerned at the moment with certain signs of a bubble in some national markets because too much money having been raised for certain mid-market segments. As an answer to that, we would then have some sector-focused funds or some smaller players in less crowded spaces into the selection, and that would give us a particular bias. Then we would not take our geographic spread by basically looking at the GDP of every country in Europe and allocate top-down. We would go quality first and end up with a geographical diversification rather than to create it artificially in the first place. Enterprise value range, going smaller would be something that we typically do as well. I think that I will stop there. I think this was just an example of how we would put together a portfolio, and I would terminate maybe on the last slide. Encore. Yeah. Which is that different investors have different needs. And as service providers, we have to be able to offer different kind of products. I mean, putting together a fund of funds for private individuals, which are very much liquidity constrained and might not have the same type of time horizon than a pension fund would have, forces us to get in business and associate ourselves with asset managers, for instance, or banks, and put together label funds that bear their name but are managed by us. I think that's one way of trying to tailor a product to a certain kind of investors. Some investors also have existing portfolios, legacy portfolios, that maybe are 100% focused on one country. And then we help them to redeploy, refocus that, and get more pan-European, more international in their portfolio in order to get to a better diversification. And lastly, special accounts. Among our investors are very large pension funds that use us as a niche manager. They already have a gatekeeper, they already have several funds of funds, but they view our specific market corner as something of interest to them that their existing gatekeeper can't cover, and they're using us to fill that space. Thank you.
Okay, so I think we will go directly to the second presentation by Laura, which is really complementary with the first one. It's on funds of funds, but specialized in secondary funds.
Hi, good afternoon. I'm going to start by introducing Headway, and then I'll say a few words on secondaries, but I will try to keep it brief so that we can have an open discussion, which I think may be interesting. Headway was founded in the beginning of this year by a team that came from Collar Capital. Like Collar, we specialize in secondaries, and our goal is to provide liquidity for all types of private equity investments. Basically, we do three types of transactions. The first is we purchase limited partnership interests in private equity and venture capital funds, and thereby become a replacement limited partner in these funds. The second is we purchase portfolios of direct investments, such as those found on bank or corporate balance sheets. In addition, we also purchase tail-end assets from private equity managers themselves. Our target transactions are small, and we have a global mandate, but focus on European and North American assets from our base in London. Finally, we are backed by 2 large family offices, each of whom have significant private equity programs and a long track record of alternative asset investments. Now let's talk about secondaries. Many of you have probably seen this slide before in some form. What it shows is the amount of capital that has been raised for dedicated secondaries funds over the last several years. I believe it actually understates the amount of capital available for secondary transactions because it excludes the allocations of funds and other investors for secondaries. Basically, this chart implies 2 obvious facts. One is that people are selling. So secondaries is becoming an increasingly acceptable method of exit for various investors due to financial reasons or strategic reasons. And the second is that investors are investing, which is really the topic of this panel today, is that people are willing to pay the secondary manager fees and carry. And the question that I guess we are here to address today is it worth it? As you know, a secondaries fund is really a type of funds. At the end of the day, the portfolio is quite similar. It consists of a group of fund positions. Even direct asset deals can be viewed as synthetic funds with a single LP. The key difference is how you get there and how you build the portfolio. Secondaries players, as you know, buy into funds much later, a few years into their investment cycles, and because of that, pricing is critical. You can actually see the assets that you are buying, and therefore the skills required to value those assets is different. It's much more akin to the skills required for direct investing, whereas fund-of-funds investors spend a lot of time focusing on teams and track records, which is also important for secondaries investors. We also spend a lot more time valuing companies from a bottoms-up perspective because that's the key for us. In addition, the approach is more opportunistic, and a secondaries portfolio will not always be composed of the top-tier managers in private equity. Oftentimes, a mediocre or a poor performer from a primary perspective can be a very attractive secondary investment. In terms of the benefits of investing in secondaries, I think Marlene covered some of these before. Secondary shares a lot of the benefits of fund-of-funds investing. It provides access, diversification, a reduction of administrative burden. More interestingly, I think, are the last 3 points, because secondaries provides an extremely interesting risk-return profile. Because you're investing in assets that are already there, you can see what you're buying, you can see how a prospective fund is performing, and thereby you can reduce the blind pool risk. Now, this all depends on being able to value assets competently. If you can do that, you can reduce the risk of investing. In addition, because you're buying several years into a fund, after significant drawdowns have been made and fees have been paid, and as the fund is starting to realize early returns, you can also generate cash much more quickly from the portfolio and also have a muted J-curve effect. Many of you have seen this chart before as well. What it shows is the traditional J-curve for primary private equity investing, where you have a J-curve because things are held initially at book value, and the value of the fund is weighed down by fees as well as early write-downs. Now, as you can see, a secondary fund can have a very different J-curve because often investments are purchased at a discount to net asset value, and again, you have the cash back much sooner. Because of this, secondaries can be a very interesting complement for private equity programs. People can use these to reduce the J-curve effect across their entire portfolios, as well as to generate early cash distributions, which can then be used for to meet unfunded commitments or even to make new commitments. And indeed, today there is a wide choice of strategies in terms of secondary players. You have large global players, you have players focused in the US, players focused in Europe, players focused on countries or regions in Europe as well. You have sector-focused players, players focusing on biotech or tech VC. There are early and manager secondaries, which are people who focus on fund positions in funds that are less than 50% invested, which is sort of a hybrid between fund of funds investing and secondaries investing. Then you have people who purchase fund positions, people who do direct asset deals, and groups that do both and provide a full range of solutions. And I would place Headway in the box that I've shown on the slide here. So much of what I've said has been targeted towards investors. As I mentioned, I will keep this brief so we can open it up to questions. But the last slide is for potential sellers. Here's a favorite quote of mine from billionaire investor Richard Rainwater.
I want to say a few words about family offices as a whole, and not specifically about today's topic, but just to explain the situation in France, and then from there we'll move into the fund of fund and private equity. I'm speaking now in terms of the Association Française du Family Office, French Association of Family Office. We gather both professional actors and family offices and families. And the family offices in France, I count something like, I estimate them because nobody knows precisely, but something like 30 real family offices in France, which is consistent with the idea of about 300 in Europe and compared to 3,000 in the United States. Those are real family offices made of more than one senior person. In addition, there would be roughly something like 150 quasi-family offices that is made up only of one person working full-time or part-time but dedicated to a family and dependent from the family for his monthly paycheck. In addition to those, and this, of course, the first 31 I mentioned would be the top 30 in the different rankings you may have in France. And then 150 more. But after that, you have the ultra high net worth individuals who could be included into the kind of clients you might be interested in by private equity, and especially by funds of funds, in view of what has been just said. Does it work here? No problem. Can you hear me? No problem? No, okay. So those ultra-high net worth individuals would tend to define, in as much as it would be concerned by family office activities, by multi-family office activities, that is not family offices dedicated to one family, but family offices working for different families, especially depending from financial companies. Those I would define as having 10 to 15 million minimum 10 to 15 million euros minimum as financial assets. For those people, we're talking about long-term objectives. And as far as I'm concerned, long-term objectives mean first defining the strategic asset allocation. We talked about that earlier this morning, but this is the basis for everything regarding a family. I'm thinking, in fact, in terms of 99 years, to think, well, all those people, they have made money, they're pleased, they've worked a lot, but now they would like the grandchildren of their grandchildren to take advantage of it. So they have to define their asset allocation and strategic asset allocation. It holds, okay. In a way that it will be able to support, to go through all the crisis, inflation, deflation, potential wars that we might meet in the coming 99 years. And in there, what is the share of private equity and maybe fund of funds? And they have made some kind of estimate, which is worth what it is worth, because nobody knows and there is no rule. Each family works differently. But if you want to make sure that whatever happens in the coming 99 years, it will go through, I have something like 10 to 20% in real estate, 20 to 40% in fixed income, whether it is cash, money instruments, or bonds, long-term bonds. And the rest, that is something, let's say, roughly 40 to 60% in equities. And within that equity part comes private equity. And I would say that within that 40 to 60% share of equities, there would be roughly 10% of the families would be ready to have at a rather higher risk. Most of it, the bulk of it, will be high-quality, long-term investments in good quality companies. The rest of it, they're ready to make at risk, and that might be emerging markets. And they would consider private equity investment as part of this 20%. And I give this figure of 20%. Someone may say it's 15, I don't know. But it's just an estimate to show what kind of amount it can represent. Now, the whole thing will depend upon the nature of the family, how it is organized, but mostly is there an entrepreneurial spirit or not? Do they consider that the investment they still have in their own family-owned company is sufficient, and therefore they want to to have a larger percentage invested in fixed income instruments? If they have a family office, they will have to choose who will head this family office. Sometimes it will be someone more involved in tax and legal aspects. Sometimes it will be an accountant. And sometimes it will be someone who is specialized in financial asset management. Normally, the role of the family office should not be to invest and to manage the financial investments. It should be to supervise the work which is done by others. So the family office is there at the side of the family to assist the family in the choices. And among the choices, there will be the choice of the fund of fund in private equity, which will be used as a vehicle in that very specific sector.
Before we turn to you, to the audience, I'd like to ask a few questions to the speakers. First I'd like to ask a question to Philippe. We saw a graph which I thought quite interesting when the performance of funds change over time, vary a lot over time. And at the beginning there is not so much variation in performance, and when it gets to the late 90s and after 2000, it becomes more variable. And first it's quite a high performance and followed by a quite low performance. So what I'd like to know, I don't know if there is an answer, but is this type of performance due to some kind of market effect, global market effect? Is it due to the fact that the funds get maybe older and or whatever? So that's one question. How can we explain the change in the pattern over time? Can you explain that? I don't know.
Yes. I think that chart, which was showing average private equity returns and was looking at the various quartiles in the performance, showed a ramp up in the performance delivered by the top quartile over the good years in VC. And I think it's very biased to venture capital and technology investment at this point in time. So 97, 98, all the run up to the crash, you saw the highest performance being reached, and you saw basically people shooting for the stars and getting extremely exciting returns. At the same time, when the bubble burst, what you saw is that reversed into the almost lowest historical performance. So basically, too much money being spent in tech assets over the years 95 to 2000, translated in the early phase into great returns, because I mean, people were sort of fueling the bubble. And when the bubble burst, what it meant is that the top quartile went down, and that the bottom quartile gathered momentum. If you were really try to dissect the bottom quartile figures in there, you would see that most of the people that ended up there will probably never raise a fund again. So I think the sample on the VC side will have changed dramatically over this span of 5 years. That from that historic performance derives the ability to raise new funds. But that again relates mostly to venture capital. That the buyout momentum is very different from that one.
Just one corollary. How would it look like if you go further, like just now because it stops at 2002? Yeah.
It's because statistics have to be compiled on the past, unfortunately. If you could get statistics on the future, we'll all be rich. Unfortunately, yes, it does stop in 2002. We can get the 2003 figures from venture economics. The bias that you get in the later years is that there's a lot of unrealized investments, and therefore you're looking at a third of all buyouts being valued on fair market value, 2/3 of all buyouts being kept at cost, and in the VC world, valuations are pretty depressed. If you look at net asset value of venture funds, you will see that most of them are held below cost at this point in time. So obviously, the more recent picture will not show a dramatic improvement as an average of buyout and venture put together. Buyouts, however, have shown an increasing performance pattern, contrary to what venture has experienced.
Thank you. Maybe we have a question from the audience.
Could you give us an idea about the cost for the investors in terms of management fees, carried interest? How does it accumulate, or how it doesn't accumulate to primaries and both for primary funds and secondary funds anytime? Because there is probably a market, but we don't know very much about it.
I can speak for secondary funds. There is a range, as one would expect, but typically management fees range from about 1.25% on commitments for during the investment period to about 1.75%, and carried interest is in the range of 10% to 15%. Now, obviously, there are outliers for each of these numbers, but that is the standard range. I think Marlene made a very good point earlier today when she said that the difference is that it's not double fees and double carry because we price that into our transactions. In the sense that when we are pricing assets for purchase, it's obviously a negotiated price. We look at the returns that we expect for our investors post our own fees and carry as well.
So it's net. It's net for the investor. When you're talking about 1.25 to 1.25, it's management fee, which is net.
We can price it into our transactions.
It doesn't accumulate.
I'm not sure what you mean by accumulate.
Is there a running management fee for the fund that
yes,
you purchase?
There is.
So it's cumulative. It's 1.25 plus the management fee of your assets.
Yes, but you price that into the purchase price of your assets.
Okay.
And our activity is, a typical portfolio is 80% primaries and 20% secondaries. I mean, we do totally buy into the speech of Laura in terms of understanding what the secondaries do for you in a portfolio allocation. So we do use that, however, on a more opportunistic basis, because we do believe there are cycles in terms of how many assets are for sale and what's the price of those assets. So we typically have had 20% of secondaries. Our fees, to answer your question directly, is 0.85% per annum, so 0.85. And that is for the first 4 years. Then it declines based on the net cost of the underlying portfolio. So as assets are being exited, I mean, the basis for calculating that fee reduces. Our carried interest is 7.5%. After a 6 to 10% hurdle, depends on the products. I mean, the highest we've had as a hurdle has been 10%, the lowest has been 6%. There again, it depends on the products. Obviously, those fees do differ when we get larger commitments or we get advisory contracts. I mean, this is the product for our standard product. That means the most expensive that we have. Obviously, an investor like we had recently that commits $200 million to our fund, we're not going to give them that pricing, we're going to go lower. So that gives you an idea. And it's per annum and it accumulates.
Well, I think you have more questions from the audience.
Yes, thank you. There seems to be a tendency for the large LPs to be increasing their asset allocation to private equity. At the EFCA conference earlier in the year, there were some estimates that something in the region of between 2 and 3 times the amount of money that has been available over the last 5 years will be available in the future. That is a huge amount of money. Could any of the panelists tell us whether this, in their opinion, is likely to change the whole structure of the private equity industry, or is it just going to be more of the same with everybody looking for the few top quartile managers? Thanks.
from our point of view, we see it as future potential deal flow on the secondary side. So it's good news for us.
I share your view that there's a lot of money coming in, especially money coming from the other side of the Atlantic. And that is inevitably going to change the dynamics of certain markets. It might go towards decreasing returns in certain areas. And I think that the European buyouts have been doing fantastically well over the past 10 years. Now, when you look at how auctions have spread down in terms of deal sizes, and when you look at the fact that funds are getting bigger and that people are shooting constantly above their league for the next fund, one can reasonably be concerned with that development, especially with the fundraising frenzy that we're going to see next year. I mean, we, as everybody, and probably as Laura does, we do a roadmap of when funds are coming to market, because you want to have visibility on the next 2 to 3 years of who's raising what and when. And we see so many people coming to the market next year, be it large buyouts or mid-market. So I think we have to adapt our strategy in order to sort of not follow the crowds, but avoid the crowd and go sectoral, go smaller, go different geographies. This is really what we're trying to tailor into our portfolio. And I do believe that some funds are going to see decreasing returns. Because you cannot have 3 times the money and expect that everything is going to stay the same. So really, there are sources of concern, definitely.
Just a word, not on the consequences, but on the phenomenon. I can confirm also that seen from the family offices, there's the same trend to develop, to increase the share of the wealth which is invested in private equity. And the figure I mentioned, which is rather a target at present time of 10%, will one day be of 15% like it is for the Yield and Demont Fund, which is about the same kind of nature of philosophy.
Well, maybe I have one question for Laura. I wondered, when you buy secondary fund, typically what is the age of the fund? And another thing is, how do you value this fund? And the value for you, is it different from the value for the fund? You said you just provide liquidity, so do you think that you purchase at some kind of a discount to provide liquidity to the initial fund holder?
Okay. The first question is, it varies in terms of how old the fund is when we buy in. It's typically, anywhere from 2, 3, 4, 5 plus years old. The way that we value the assets is that we actually look at each company and we take a view on what we think that the prospects of that company is, what we understand of the GP's strategy and their skills, and we project an exit for that asset, and we do this for each asset in the fund. Does that answer?
Yeah.